All right, welcome everybody to our Q4 2020 market update video. 2020 was a year for the history books, and at times it was extremely exhausting, and that's putting it lightly. I wanted to take a moment to set the stage for what we're going to go over today. First, we're going to give you a 2020 year in review. This is going to cover the elections, vaccines, the markets, tech stocks, and of course the day traders. From there, we're going to get into our standard market commentary and recessionary checklist. Ultimately, we also want to revisit our investment philosophy and of course what we're buying and selling. Lastly, but not least, we're going to go over the performance of our portfolios. So let's jump into the 2020 year in review, starting with the US election results. Now, outside of the pandemic, the single largest event for the year was actually the US election. In our Q3 review, I'll put a little link to it right up here if you didn't catch it, we thought it could go one of two ways. If we had a contested or drawn out election, the markets would likely sold off. On the other hand, if the election went smoothly, which it ended up doing, and ultimately Biden won, the markets would react favorably to this, which of course they have. Now, President Biden, now in full control of the world's top economy, has vowed to make some major changes. First and foremost, tackling the coronavirus is his #1 priority, which he plans to do by doubling the number of drive-through testing sites, investing in next-generation testing, including at-home tests and even instant tests. He ultimately plans to invest about $25 billion into a vaccine manufacturing and distribution plan. Now, an interesting stat, according to experts, is that if only 95% of Americans could manage to wear a mask between now and, let's say, Christmas, potentially 700,000 lives could be saved, and that's something to think about. All right, let's talk a little bit about the markets. The financial markets in 2020 will go down in history books, and we're probably going to be taught in MBA programs around the world for decades to come. The S&P 500 experienced its fastest ever bear market, coming in at just 33 days before having its third fastest recovery to a break-even level in just about 5 months. This just goes to show you that the stock market is actually pretty resilient and tough to take down, and also that businesses adapt and learn how to make money during both good and bad times. A big takeaway of what happened this year is that market performance is not always tied to economic performance. The market is willing to look at this as a one-time event rather than as something fundamentally wrong with the economy, let's say like what happened in 2008. Now let's get into tech stocks and day traders. Okay, FANG stocks, which stands for Facebook, Apple, Amazon, Netflix, and Google, all had phenomenal 2020. Facebook returned over 30%, Apple over 78%, Amazon over 71%, Google over 30%, and Netflix over 67%. This is largely due to millennials working from home, and a unique phenomenon is that day trading absolutely exploded during COVID. Now, Robinhood, which is a free trading platform in the United States, saw its user base grow to over 13 million users. And interestingly, the average age is actually only 31 years old. Now, not surprisingly, the shares of heavyweight technology companies led the market out of bear territory and ultimately helped propel the tech-skewed NASDAQ Composite Index to all-time highs in June, 2 months before the S&P 500 did the exact same thing. Okay, let's talk a little bit about vaccines. Well, Pfizer and Moderna vaccines are approved for use in North America, and both of these vaccines are what we call a 2-dose system. A game changer could be coming around the corner in the form of a single-dose vaccine that actually can be stored at home potentially, and this is being created and offered by Johnson & Johnson. To date, nearly 4.6 million people have been vaccinated, which is nearly 2 times the number of deaths worldwide. Okay, so let's get into a coronavirus update. I think we can all kind of sigh a little bit of relief here in that there's light at the end of the tunnel, and this is a good thing, and there's positive news coming around, which is fantastic. However, I think this brings some unique challenges to the table. I think we all need to be careful. Confirmed case numbers are still going up, and I think this is partially due to people continuing to become more and more relaxed about the virus. I would say mainly due to COVID fatigue, ultimately, and the fact that we all know that viruses are coming. It's just a matter of time. This can become fairly dangerous and I think has a potential to create more short-term pain. And of course, as they say, the night is darkest just before the dawn. So for everybody out there who's starting to get impatient, just be mindful of the fact that good things are coming, but don't let go of what we're working on, what we've all worked so hard for and sacrificed. Now, one of the new developments that we're watching with regards to the vaccine news is actually coming from Johnson & Johnson. Again, I stated earlier that this could be a game changer. I actually made an entire video on Johnson & Johnson, and I'll actually link it up here if you guys didn't check it out. It actually happens to also be one of our highest conviction stocks of 2021. Now, one of the more alarming facts about the virus that's going on right now, and this whole pandemic as a whole, is the fact that there's the emergence of variant strains of the virus happening within different countries. The White House task force came out and warned that some COVID-19 strains may have evolved into a more transmissible virus. Now, right now, the research is still inconclusive, but there's a real fear out there, and we're all monitoring it very closely. Over 107 million people worldwide have been infected by the coronavirus. This is representing nearly 1.5% of the entire population of the planet. Now, deaths, unfortunately, have also ballooned up to about 2.3 million. Now, as I previously discussed, some countries have done better than others at containing the virus, specifically around testing and administration of the vaccine. Now, the United Kingdom by far leads the world when it comes to testing. They have conducted more tests than the entire population. A clear sign that testing is of utmost importance to them, and the United States, Russia, and Spain have also done a great job testing their population. Unfortunately, India, Turkey, and Brazil have not done such a great job. So let's take a really wide-angle look at the daily case count worldwide. As we ramp up testing, case counts will continue to increase. But what is interesting to note is that even as the testing increases, we are finally starting to see sustained decreases in daily cases for the first time since the pandemic started. This is indeed due to the fact that vaccines are actually being administered. And despite it being done slowly, of course, every vaccination counts. Okay, so let's get into a market overview. Well, 2020, again, was a year for the history books. And any way you want to look at it, it was historical. Amid a global pandemic, investors in cannabis, tech, healthcare saw double-digit returns to the end of the year. The decline we saw in March and April was the fastest in history of finance, taking only 16 days to fall 20% and only 19 days to lose 30%. What was even more impressive was, of course, the recovery. The collapse from the tech bubble, from peak to trough to peak, took nearly 75 months. In the financial crisis of 2008, it took approximately 55 months. With the COVID sell-off and rebound, it took approximately 180 days. So another watershed moment was the explosion of retail or day traders on platforms like Robinhood and Questrade. Again, mainly driven by the fact that these platforms are offering free trades, but also because thousands of millennials were now at home with a lot of time on their hands. Every North American index, from the Toronto Stock Exchange to the S&P 500, finished the year in positive territory, with the tech-heavy NASDAQ posting an astonishing 44% return. Now, this is the investment quilt that I've talked about before, showing returns for almost every major equity and fixed income indexes over the last 8 years. On the equity front, outside the United Kingdom, which is still having issues dealing with the Brexit debacle, all major global stock market indexes finished the year in positive territory, driven largely by Asian and emerging market equities. When we say emerging markets, we're really referring to countries like Russia, Brazil, India, China. An interesting note, which we have highlighted in the red boxes, the S&P 500 index has enjoyed one of the better runs when compared to, let's say, some of the other benchmarks that are out there. So let's switch gears and look at our fixed income or bond indices. Remember, when bond yields decrease, their prices actually increase. They have what we call an inverse relationship. Well, that's exactly what happened in 2020. mostly during the first 2 quarters as central banks completely slashed their interest rates to help combat the coronavirus. Across the board, with Japanese bonds being the exception, fixed income returns were actually really positive last year. Now we're going to take a moment to look at 3 major indices, the S&P 500, the TSX, and the MSCI World, along with the 10-year Canadian and US bond indices, along with gold. Bonds and gold really stole the show in the first quarter. This is not surprising though. This is right when the pandemic was just gripping the world, and these are known as some of the flight to quality or safety trades when there's fear in the markets. After Q1 though, Canadian and US 10-year bonds basically remained flat for the remainder of the year. Gold continued into midway through the third quarter and then started to slowly grind down for the next 3 months before kind of popping in late December to finish the year up about 23%. Looking at North American and world equity, they basically moved lockstep last year. Unfortunately, the TSX did lag the world and US markets overall. From the depths of March, the S&P 500 bounced up by about 45%, finishing up on the year roughly 16 to 17%. In the 2 months prior to the US election, equity markets retraced, only to explode upwards after the Democrats claimed victory. Okay, let's get into the recessionary checklist. Now, this is something that we like to do every single month. Well, Canada, when we're looking at Canada through the lens of the consumer, there aren't many positive things to point at. Unemployment, while down from their peak of about 13.7% in May, still hovers at around 9 to 10%. And this has to put the consumer confidence on kind of shaky ground. Consumers are more likely putting the big purchases on hold, including but not limiting to home purchases, which is why we are seeing housing starts remain in caution territory. Interestingly enough, potentially contrary into the gut instinct, but bankruptcies have actually remained extremely low throughout the global pandemic. Let's look at the United States. Business confidence in the US rebounded nicely to pre-pandemic levels in October. But since then, it has fallen off a cliff, all the way back down to the low levels in March. And while the US has fared better at getting people back to work, their unemployment rate still remains at levels not seen since 2014. The unemployment rate in the United States today still sits at about 6.3%. Housing starts in the US have nearly doubled since the lows in April and are now surpassing their pre-pandemic levels. This is actually an encouraging stat. Looking at the UK, globally, the area which we see the largest headwinds or potential risks right now has been with the United Kingdom. While business confidence is low, the UK has only had 1 positive quarter in the last 4 years. Not shockingly, unemployment levels are not, and they have continued to climb every single month since COVID started. Due to the long Brexit debacle, consumer confidence in the United Kingdom hasn't been positive since late 2016. And this continues to be at levels not seen since the depth of the 2008 crisis. Now, with Germany, it's interesting to note that bankruptcies haven't been this low since 1994. And while unemployment sitting at 4.6% is the highest that it's ever been since 2016. Now, whether you believe the rhetoric coming out of China, China has done one of the better jobs globally at containing the coronavirus. Unemployment and consumer confidence in China is now at pre-pandemic levels. So it shouldn't be shocking that the stock markets in Asia were some of the best performers in 2020. In Japan, the unemployment remains at levels seen during the height of the pandemic in March. Almost every economic indicator in Japan remains in caution or warning territory, and that's something that we are continuously watching. Okay, let's get into our investment philosophy. In today's world of investing, there's tremendous amount of noise that exists. From endless amounts of financial magazines and TV shows to fake news and political propaganda, and of course, the social media and headline feeds. We are inundated with constant flow of information, and some of it is important, but unfortunately most of it is useless. And to complicate matters further, our biases and personal beliefs can often cloud our own investment judgments, especially during times of stress, like we've seen during the crash. So after poring over numerous investment and research papers and testing a variety of different investment models, some based off of instincts and other based off of data, we concluded that the best approach to achieve outstanding long-term success is to take the human emotion element completely out of the equation. This has led to us developing an investment model that utilizes pricing data to take advantage of strong uptrends in different markets around the world, and while also managing risks in an extremely thoughtful manner. Okay, like any good surfer knows, it's ultimately the wind that dictates their opportunities and successes. Heavy winds create big waves, while at the same time they also can be causing the most amount of devastation. The surfer's ability to spot large waves is the first step, and this usually means passing on many smaller waves until they find just that right one, that perfect big ticket wave that could be the game changer for their career. It is now the surfer's job to get into the wave, or the pipe as they call it. So just long enough to grab that amazing video or picture, but not long enough to have the wave break on them. This is a delicate balance and challenges even the best surfers around the world. Getting things wrong at this stage can be absolutely catastrophic. Just as the best surfers around the world want the biggest waves, investors typically want the biggest returns. And identifying which investment or waves will be too small for them to invest in and which ones will be in turn game-changing wins is always half the battle. So on the next slide, I'm going to explain how we try to predict these investments, which will be winners versus those that will be losers. Large waves have stronger momentum, and investments with strong momentum tend to produce outsized returns. This is what we're looking for. The length of time that a surfer spends in the pipe can be similar to how long we can stay in the investment. We're looking to ride that wave of positive momentum in a given investment as long as possible. The trick with momentum investing comes in with trying to identify when the wave will break, or when the investment's momentum will shift negative, without your investments getting crushed in the process. As portfolio managers, our goal is to pass up the small waves and identify those money-making waves. And all too often with an investment, people tend to hold on to losing investments for way too long and sell winning positions way too quickly. By employing a momentum-based strategy, we can stay in winning investments. Many of you who have worked with us for quite a while will likely have seen this graphic before, but this portrays our investment process into basically 4 simple steps. In a continuation from our last slide, the first step is really just gathering a pool of uncorrelated, diversified products. Whether they be mutual funds, hedge funds, ETFs, stocks, we're looking to collect as many different investable options as for our clients as possible. From here, we're basically implementing that momentum-based screen that I previously discussed. Finding that big wave investment. So once we know who's in and who's out of the portfolio for that given month, remember, we're conducting this process every 30 days. It isn't enough to simply find the investments with the greatest potential to make money. We must also ensure that we're managing risks that come along with such a position. Some of our clients are very conservative and others are of course more risky. So we must ensure that each and every single client gets a portfolio and of course an investment experience that is tailored to their specific situation. So the last step ultimately is waiting, which is when we take an investment that has scored well from a momentum perspective and of course adjust the sizing of this position to ensure that we're meeting a particular amount of risk. Going through this process every month is extremely important. The world is always changing and so too should your portfolio. The days of a set it and forget it, 60-40 standard balanced portfolios are long over. Okay, so let's get into the meat and potatoes for what we're buying. Let's start off with our sustainable equity portfolio. Johnson & Johnson's been around since 1886. They have revenues nearly $83 billion, and it's one of the world's most valuable companies. The big news here is the imminent approval of a single-dose vaccine, which should be a game changer for the fight against the coronavirus. Johnson & Johnson currently represents the single largest holding in our current equity model. Now, our second largest holding was WSP Global. They were founded in 1959. WSP gives investors exposure to the management and consulting industry. WSP is headquartered in Montreal, Canada, and currently employs over 50,000 people, with a strong Q4 return to the tune of 38% Out of all firms we track in our equity model, WSP is exhibiting one of the strongest trending names that we have. Activision Blizzard is one of those stay-at-home stocks that had a great Q4 and rounds out our top 3 equity positions in the portfolio. Activision Blizzard specializes in producing some of the world's most recognizable games, like Call of Duty, Guitar Hero. In our Q3 webinar, we actually indicated that we didn't own Activision Blizzard at the time, but it would be shocking if the firm wasn't back in the portfolio during Q4, which is actually exactly when it ended up happening, finishing the last 3 months of the year up nearly 15%. So the first sell recently was Rollins, has actually evolved greatly over the years. Starting in 1948 as a broadcasting company after the founding brothers purchased 1460 WRAD, an AM radio station in Virginia. Since then, the company has spun off and they have numerous divisions, and one of which now focuses exclusively on providing pest control to over 2 million customers around the world. While we in general like the firm, as you may know, investing in our group is less about what firms we like and more about what the firms can earn for each of our clients from a rate of return standpoint. And frankly speaking, Rollins has done a whole bunch of nothing as of late, starting in late September at $37, which is precisely where it still stands today. So the next sell, Ritchie Brothers. If you remember, on our last quarterly update, we were raving about Ritchie Brothers and their ability to morph through the pandemic, moving all their auctions online. Now, really, we still love the firm, and our clients made a good amount of money holding this over the past year. And I wouldn't be surprised to see it back in the portfolio again during 2021. But like every good thing, positions time in the sun, and they also tend to have time in the shade. We've taken our profits and moved on. Now, Amazon, very similar to Rollins, Amazon is a great firm, and it just hasn't had a whole lot of positive momentum lately. The firm's stock has traded sideways since July. The moment that changes to the positive, we'll likely jump back in the name with ultimately 2 feet. But for the meantime, we're going to be on the sidelines waiting to see for an uptrend. Okay, so now let's look into what we're buying in our Canadian and US dollar ETF portfolios. Okay, so firstly, US TIPS. One of the largest changes in the fixed income shelf in our ETF model over the last quarter has been a shift from medium-term bonds into US TIPS. As an inflation picks up, bond prices tend to follow, which negatively affects holders of fixed income securities. Purchasing TIPS, which reset month to account for inflation, allow our investors to hold fixed income without the drawbacks that inflation typically brings. In Canada, we use an ETF offered by Mackenzie under the symbol QTIP, and in the US, we actually use Vanguard's VTIP ETF. Another addition is Asian equities. Through 2 ETFs, we gain exposure to Asian equities, and our investors have gained exposure to one of the better asset classes ultimately of Q4. The largest geographical regions in these ETFs that they cover are Japan, Australia, Korea, Hong Kong, and Singapore. Another one that we've been adding was global healthcare and technology and innovation. Aging demographics and massive expenditures in research and innovation and a global pandemic has made way for companies in the healthcare sector to reach all-time highs. The ETF we use to gain exposure to this sector is H-Tech, offered by Robo Global. This ETF is up over 78% in the last 12 months and includes many names not included in major indices. This ETF has been one of our best investments during Q4. Okay, now let's look at what we're selling in the Canadian and US dollar ETF portfolios. First, we're selling short-term government and corporate bonds. Previously, we discussed our movement into US inflation-protected securities as inflation is starting to pick up. With that being said, it shouldn't be surprising that we're starting to move out of short-term bonds and both corporate and government bonds. Another one that we've actually been getting out of is gold bullion. As many of you may recall, in our last quarter webinar, we started selling Franco-Nevada, a Canadian gold royalty firm. At the time of recording, we've completely sold out of all of our gold positions, which has proved as well as gold has traded sideways for the last 3 months. Another one we've liquidated is water resources. Water purification, distribution, and bottling is a big business. To gain exposure in the sector, we used a few ETFs. Over the course of Q4, clients invested in the PHO ETF made over 17%. Momentum has since slowed down in the sector, so we're taking some profits off the table. from a portfolio performance standpoint, I just want to show you guys the chart. Now we run different strategies along for both our Canadian clients and our American clients. 2020 was a volatile year. And what we're happy about is the fact that we actually ended up in positive territory in not all but I think one portfolio ultimately, which is our US conservative ETF portfolio. Outside of that, every single portfolio ultimately ended up positive. We're most proud of actually our sustainable equity portfolio, which of course is not suitable for all people. It is on the higher end of the risk spectrum. But what I will say is we're very proud of the fact that we've actually given a return that is greater than the S&P 500. And I'd even say the Dow, it's been more than double that of the Dow, but interestingly with about half to a third of the risk. So really this kind of proves that 2020 being as violent of a volatile year as we basically have seen in many, many years, that our tried and tested methodology of maintaining a specific amount of risk at all times and also being mindful of momentum has yielded positive results. So that's basically our portfolios in a nutshell. 2020 was a really interesting year, and it's one I think that we're all going to be talking about for a very long time. I'm sure we're all getting tired of the fact that we're having absolutely epic life-changing type events almost on a quarterly basis, whether it be people charging the Capitol building or things of that nature. We want to really be mindful of the fact that we're putting these things into perspective. What is it that we're looking to accomplish? What are your goals? What are your objectives? And really making sure that we actually dial into not just broad benchmarks that we see on those stock markets, but benchmarks relative to you and your life. And that's something that I've always stressed, and anybody who I've talked to in our meetings, this is something that's really important for everybody to keep in mind is really financial planning based benchmarks. So where do you need to be where are you relative to where you need to be? And how much risk are we taking? So we've done really well overall. We're happy. We really appreciate the support that you guys have given us over the past while. You know, we're happy to answer any questions that you might have. And of course, like always, please stay safe out there and happy investing. Bye for now, guys.